Welcome back to the Deep Dive. Today we're jumping into, well, let's face it, a really complex area, U.S. tax compliance for non-citizens and non-residents.
It's definitely a maze.
It is. We spent time digging through the 2024 IRS Publication 519, trying to pull out the essentials so you don't get lost in, all the official jargon.
Good plan. It's dense stuff.
Our mission today is really to draw a clear line between being a resident alien and a non-resident alien for tax purposes. It sounds simple, but getting it wrong is potentially serious.
Oh, absolutely. Using the wrong status, or worse, filing the wrong form, like a standard 1040 when you should have filed a 1040 NR, that can lead to some pretty hefty penalties.
Right, and it's not just about the money, is it? It can actually put your visa or even your green card status at risk.
Exactly. That's why understanding this fundamental distinction is so critical. If you're classified as a resident alien for tax purposes, you're basically treated like a U.S. citizen. Meaning the IRS wants to know about your worldwide income. Everything. Doesn't matter if you earned it in London, Singapore, or right here in the U.S., it all goes on the return.
Okay, worldwide income for resident aliens. But the non-resident alien status, which, let's face it, applies to a lot of people here temporarily on visas that works differently.
Completely different. Non-resident aliens are generally only taxed on income from U.S. sources. And even more specifically, it often comes down to income that's effectively connected with a U.S. trade or business.
So, worldwide versus U.S. source, that's the core difference we need to unpack. Getting this right from the start is, well, step one.
Definitely step one.
Okay, let's tackle that first step then.
Yeah.
Figuring out your tax residency status. We said it's not just about your visa, right? It's this thing called the Substantial Presence Test, or SPT.
That's the main one, yes. And it trips a lot of people up.
I think the common assumption is, I don't have a green card, so I must be a non-resident alien.
That's a dangerous assumption. Very dangerous. The SPT ignores your visa type for the calculation itself. It's purely about counting days, physical presence.
How does the counting work?
Okay, two parts. First, you need to have been physically present in the U.S. for at least 31 days during the current calendar year. That's usually the easy part.
Usually.
Right. But the second part, that's where the complexity comes in. It involves a 3-year look back.
Ah, the weighted calculation. This is where people get caught out, I bet.
Exactly. To meet the SPT, your total presence over a 3-year period has to hit 183 days or more, but it's weighted. You count all the days you were present in the current year.
100% of this year's days.
Yes. Plus 1/3 of the days you were present in the first preceding year.
Okay, last year's days count as 1/3.
And finally, 1/6 of the days you were present in the second preceding year.
Only a sixth from 2 years ago. So wait, let me see if I get this. If I was here for, say, only 60 days this year, but I spent a lot of time here 2 years ago, maybe 240 days, I could still accidentally become a resident alien for tax purposes.
You absolutely could. Let's do a quick example. Say, 2024, you're here 60 days. That's 60.
Okay.
In 2023, maybe you were here 120 days. 1/3 of that is 40 days.
Right, 40.
And in 2022, you were here 180 days. 1/6 of that is 30 days.
Okay.
So you add them up. 60 plus 40 plus 30. That's 130 days. In that scenario, you're under the 183-day threshold. You're still a non-resident alien.
Ugh.
But you see how easily it could tip over if those prior year numbers were just a bit higher. Maybe you hit 150 days last year instead of 120. Suddenly you're over 183.
It really catches those who come regularly, even if not for the whole year.
Precisely. And for green card holders, lawful permanent residents, there's an added layer here. It's not just about taxes.
What do you mean?
Well, immigration law basically says if you're an LPR, you meet the SPT, you're required to file as a resident alien, but you don't. You could be seen as having potentially abandoned your permanent resident status.
Wow. So filing correctly is tied to maintaining your green card.
It absolutely can be. The IRS and USCIS do talk. You need to fulfill your tax obligations as a resident if you are one.
Okay, but there's a way out for some people caught by the math, right? The closer connection exception, Form 8840.
Yes, that's the escape hatch, but it has strict rules. First big one. You must have been in the U.S. for less than 183 days in the current year. You can't use it if you spent more than half the year here.
Less than 183 days this year. Got it.
Second, you have to prove you maintained a tax home in a foreign country during the year.
And what does tax home mean? Is that just where you live?
It's generally your main place of business or employment, but it's more complex than just residency. And third, you have to demonstrate a closer connection to that foreign country than to the U.S.
How do you prove a closer connection?
The IRS looks at things like, where's your permanent home? Where does your family live? Where are your personal belongings, your furniture? Where do you bank? Driver's license, voting registration. A whole list of factors.
And the absolute key to using this escape hatch.
Filing Form 8840 on time. You attach it to your timely filed tax return, usually a 1040 NR. If you miss the deadline for filing that form, you basically lose the chance to claim the closer connection. The SPT result stands.
So file on time. Crucial. Now, what about exempt individuals? This sounds like good news.
It is, especially for students and scholars. If you're in the U.S. on certain visas, typically F, J, M, or Q visas as a student, teacher, trainee, researcher, or even some athletes for charitable events,
Yeah.
the days you're present primarily to fulfill the purpose of that visa generally don't count towards the substantial presence test.
Oh, that's huge.
Yeah.
So a student on an F1 visa might be here for years, but still be a non-resident alien for tax.
Exactly. There are limits, of course. Students usually get up to 5 calendar years where their days are excluded. Teachers and trainees often get 2 years out of the last 6. But yes, it prevents them from automatically becoming residents just by being here for their studies or research.
And they need to file something for this too, right?
Yes. Form 8843, Statement for Exempt Individuals. It's vital. Even if you have 0 U.S. income, filing Form 8843 is how you officially tell the IRS, don't count my days, I'm exempt under this visa rule.
Okay, so let's say you've gone to the SPT, maybe used an exception or exemption, and determined you are a non-resident alien. Now, how is your U.S. income actually taxed? This is where it gets quite different from U.S. citizens.
Radically different. For non-resident aliens, U.S. source income has to be split into 2 main categories, ECI and FDAP.
ECI. That's effectively connected income.
Correct. And FDAP is fixed, determinable, annual, or periodic income. Understanding which bucket your income falls into is everything, because it determines your tax rate and whether you can take any deductions.
Let's start with ECI. Effectively connected income. What usually falls in here?
Think income directly tied to a U.S. trade or business. The most common examples are wages, salaries, self-employment income earned while working in the U.S., business profits from a U.S. operation.
And how is ECI taxed? More like a U.S. resident.
Yes, that's the key feature. ECI is taxed at the same graduated tax rates that apply to U.S. citizens and residents. The rates go up as income increases.
And deductions. Can you take those against ECI?
You can. You're allowed to claim deductions that are connected to generating that ECI. Think business expenses, for example. There are some limitations on things like the standard deduction for NRAs, but generally deductions are allowed against ECI.
Okay, so ECI, graduated rates, deductions allowed. Now, the other bucket, FDAP, fixed, determinable, annual, or periodic. Sounds like investment income.
Exactly. This is typically passive income from U.S. sources. Think interest paid by U.S. banks or corporations, dividends from U.S. companies, rents from U.S. property, royalties from U.S. sources.
And the tax treatment here is different.
Very different, and often much harsher. FDAP income is taxed on the gross amount. No deductions allowed.
Wait, gross amount, no deductions at all?
None. And the tax rate is a flat 30%, unless a tax treaty provides a lower rate.
Wow, 30% on the gross. That could be really painful, especially, say, for rental income. If you have a U.S. rental property bringing in $30,000 in rent, but you have $25,000 in expenses like mortgage interest, property tax, repairs.
Under the default FDAP rules, you'd pay 30% tax on the full $30,000 gross rent. That's $9,000 in tax, even though your actual profit was only $5,000.
Ouch, that seems unfair.
It can be, but there's a crucial election available specifically for U.S. real property income like rents or royalties.
An election, like a choice.
Yes. A non-resident alien can choose to treat their U.S. real property income as effectively connected income, ECI, instead of FDAP.
Why would they do that? It
Yeah.
sounds like making it ECI puts it into the graduated rate system.
Precisely. By making the election, you switch from the 30% flat tax on the gross amount to the graduated rates applied to the net amount. You get to deduct all those allowable expenses, the mortgage interest, property taxes, depreciation, repairs, management fees.
So in that example, you'd pay tax on the $5,000 net profit at potentially much lower graduated rates instead of $9,000 tax on the gross rent.
Exactly. It almost always makes sense for property with significant expenses. You make the election by attaching a statement to your return, and importantly, once you make it, it generally stays in effect for future years unless you get IRS permission to revoke it. So it's a big decision.
Definitely a key planning point for international property investors. Now, quickly, you mentioned U.S. source income. How does the IRS figure out if income, like salary, is from a U.S. source? Let's say someone works partly here, partly abroad.
Good question. For personal services like wages or consulting fees, the source is determined based on where the work is actually performed. They use a time
Time
basis.
basis.
Yeah, you basically allocate the income based on the number of days worked in the U.S. compared to the total number of days worked everywhere for that specific payment.
Okay, can you give an example?
Sure. Let's use the one from Publication 519. Christina lives in the Netherlands but works temporarily in the U.S. for her Dutch employer. She earns $80,000 total for 240 workdays in the year. She spent 60 of those workdays physically working in the United States.
So 60 days in the U.S. out of 240 total workdays.
Right. So the portion of her salary considered U.S. source income is $80,000 multiplied by 60 divided by 240. That's 1/4.
So $20,000 is U.S. source income.
Exactly. That $20,000 would be treated as ECI, subject to U.S. tax at graduated rates. The other $60,000 is foreign source and generally not taxed by the U.S. for a non-resident alien.
Okay, so sourcing rules can help limit the income subject to U.S. tax. But even that $20,000 ECI or the 30% FDAP tax can be a hit. This brings us to tax treaties. How much power do they have?
A lot of power. Tax treaties are formal agreements between the U.S. and other countries aimed at preventing double taxation and sometimes offering specific tax breaks. Critically, a treaty provision can often override a rule in the U.S. Internal Revenue Code.
Override the code, like change the tax rate.
Absolutely. For FDAP income like dividends or interest, treaties very commonly reduce that flat 30% rate to something lower, maybe 15%, 10%, 5%, or even 0% in some cases. They can also provide exemptions for things like pensions or Social Security payments from the other country.
That sounds incredibly useful. What about benefits specifically for students or researchers, people here on those F or J visas we mentioned?
Yes, treaties often have specific articles dealing with students, trainees, teachers, and researchers. These can be very generous.
For example?
Well, a common one is an exemption for a certain amount of compensation earned by students or trainees. Maybe the first $5,000 per year isn't taxed by the U.S. For teachers or researchers, some treaties exempt their entire salary from U.S. tax for their first 2 or maybe 3 years here.
Wow. A full exemption for 2 or 3 years. That's significant.
It is. But you have to check the specific treaty between the U.S. and your home country. The benefits vary widely. And you also need to be aware these things can change. For instance, a heads up for 2024, the U.S. tax treaty with Hungary was terminated, so any benefits Hungarians previously claimed under that treaty are, well, gone.
Always need to check the current status of the treaty. Now, if you do use a treaty to reduce your U.S. tax in a way that sort of conflicts with the standard rules, do you need to tell the IRS specifically?
Yes, and this is a big compliance trap. If you claim a treaty position that overrides or modifies U.S. tax law, like claiming a lower rate on dividends than the default 30%, or exempting income that would normally be taxed, you often need to file Form 833 Treaty-Based Return Position Disclosure.
Form 8833. And what happens if you're supposed to file it, but you don't?
There is a penalty. It can be $1,000 for individuals for each failure to disclose a treaty position when required. So forgetting this form can wipe out the very benefit you were trying to claim.
Ouch. Okay, forms. To file any of these, you need an ID number. Social Security number if eligible, but if not.
If you're not eligible for an SSN typically because you don't have U.S. work authorization, but you need to file a U.S. tax return or claim treaty benefits, you must get an ITN. That's an individual taxpayer identification number.
How do you get an ITN?
You apply using Form W7, application for IRS individual taxpayer identification number. You usually submit it with your tax return. It requires proving your foreign status and identity, often with original documents or certified copies. It can take a while, so plan ahead.
And there's something about ITINs expiring.
Yes, the IRS has been actively managing the ITN program. Any ITN issued before 2013 will expire at the end of 2024 unless it's been renewed. Also, any ITN that hasn't been used on a U.S. tax return for the last 3 consecutive years, so for tax years 2021, 2022, or 2023, will also expire on December 31st, 2024.
So if you have an older IPN or haven't filed recently, you need to renew it now if you plan to file for 2024.
Correct. Don't wait until filing season next year.
Okay, let's nail down the main form and deadlines for non-resident aliens.
The main form is Form 1040-NR, U.S. Non-Resident Alien Income Tax Return, not the standard 1040.
1040-NR. And the deadline?
It depends. If you received wages during the year that were subject to U.S. income tax withholding, your deadline is the same as for U.S. citizens, April 15th. So for the 2024 tax year, that would be April 15th, 2025.
Okay, April 15th if you had wages withheld. What if you didn't? Say, only FDAP income or rental income with no withholding.
If you did not have wages subject to U.S. withholding, you get an extra 2 months. The deadline is June 15th, so for 2024, that would likely be June 16th, 2025, since the 15th falls on a Sunday.
June 15th if no wages withheld. Yeah, good distinction. Now, the scary part. What if someone makes a mistake? They file late. Or worse, they're a non-resident alien, but mistakenly file Form 1040.
The penalties can really add up. Filing late triggers the failure to file penalty. That starts at 5% of the unpaid tax per month, maxing out at 25%. And if you're more than 60 days late, there's a minimum penalty, which was $510 for returns due in 2024. It usually adjusts for inflation.
Oof. Minimum $510 just for being late.
Yeah. And then there's the accuracy-related penalty if you understate your tax liability substantially, maybe by filing the wrong form or incorrectly reporting income. That's typically an additional 20% of the underpaid tax.
So a 25% failure to file plus a 20% accuracy penalty. That could be almost half the tax owed, just in penalties.
Easily. It underscores why getting the status, the form, and the income reporting right is so important.
Let's switch gears slightly. What about Social Security and Medicare taxes? FICA taxes. Does everyone working physically in the U.S. pay those?
Not necessarily. There's a significant exemption, again, often tied to visa status. Non-resident aliens who are temporarily present in the U.S. under F, J, M, or Q visas.
Students, scholars, etc.
Right. If the work they're doing is performed to carry out the purpose specified by their visa, those earnings are generally exempt from Social Security and Medicare taxes.
So an international student working legally on campus shouldn't have FICA withheld.
Correct. Their wages should only be subject to income tax withholding if applicable.
What if the employer makes a mistake and does withhold FICA taxes? Happens all the time, I imagine.
It does. The first step is always to go back to the employer. Ask them for a refund of the erroneously withheld FICA taxes. They should be able to correct it on their end.
And if the employer can't or won't fix it,
then the individual has to file a claim directly with the IRS for the refund. That's done using Form 843, Claim for Refund, and Request for Abatement. You attach documentation like your visa, I-94, pay stubs, showing the wrong withholding.
Form 843 for FICA refunds. Good to know. Okay, another common situation. Marriage. What if a non-resident alien is married to a U.S. citizen or a resident alien? Can they file jointly?
The default rule is no. A non-resident alien generally cannot file a joint return. They usually have to file married filing separately on Form 1040 NR.
But there's an exception. I feel like there's always an exception.
There is, a very important one. The couple can choose to treat the non-resident alien spouse as a U.S. resident alien for the entire tax year.
Make the choice, treat the NRA spouse as a resident, and then they can file jointly.
Exactly. They would then file Form 1040 or 1040 SR jointly. And actually, for 2024 returns, there's a new checkbox directly on the Form 1040 to make this election, which simplifies the process a bit.
That sounds like a great option for many couples. Probably gets them a better tax result with joint filing rates and deductions. But what's the catch? There must be a catch.
Oh, there's a big one. A huge one. If you make this choice, the couple is then taxed on their combined worldwide income.
Worldwide. So that spouse, who was previously a non-resident, only taxed on U.S. source income, now has to report and potentially pay U.S. tax on all their income from back home from anywhere in the world.
Yes. Everything. And furthermore, by making this election, they are specifically treated as U.S. residents for tax purposes, meaning they generally give up any ability to claim benefits under a tax treaty that would treat them as a resident of the foreign country.
Wow. So you trade potentially lower U.S. source tax and treaty benefits for the ability to file jointly. That's a massive decision.
It requires careful calculation and understanding the long-term implications, especially if the non-resident spouse has significant foreign income or assets.
Definitely something to consult a professional about. Yeah. Okay, last topic. Leaving the U.S., I've heard about needing a sailing permit or something.
That's right. It's officially called a Certificate of Compliance. Before most aliens physically depart the United States, they're required by law to get one.
Required?
And how do you get it? You have to demonstrate to the IRS that you've met your U.S. tax obligations up to the date of departure. This usually involves filing either Form 1040C, U.S. Departing Alien Income Tax Return, or Form 2063, U.S. Departing Alien Income Tax Statement.
Which form depends on your situation, I assume.
Yes. Form 2063 is simpler for those who have no taxable income or have already filed and paid. Form 1040C is more involved, essentially calculating tax up to the departure date. You typically have to visit an IRS Taxpayer Assistance Center, or TAC, in person shortly before you leave to get the certificate issued.
So you can't just pack your bags and fly out.
Not legally, unless you fall into one of the specific exemptions like diplomats, certain students, and business travelers who meet requirements. But for many long-term residents or those who earn significant income, getting that sailing permit is a required final step. Hashtag outro.
Okay, we've covered a lot of ground pulling details from that dense publication 519. If we boil it down, the absolute core lesson seems to be your tax residency status, resident alien versus non-resident alien, is driven by physical presence, the SPT mass, not just your visa.
Exactly. And that status dictates everything. Worldwide income versus U.S. source only.
And how that U.S. income is taxed. ECI at graduated rates with deductions, or FDAP at that flat 30% gross rate.
And compliance really hinges on using the right forms at the right time. The 1040 NR for filing, the 8840 if you're claiming closer connection, the 8833 for treaty disclosures, the W7 for an ITN. Getting the paperwork right is key.
Right. Now, for a final thought, something to really underscore how interconnected this all is, especially with immigration status and long-term planning. Consider someone who is a long-term resident. That means they've held a green card for at least 8 out of the last 15 years.
Okay, 8 of 15 years, that's a specific threshold.
It is. Now, let's say that long-term resident uses a provision in a tax treaty called a tiebreaker rule to claim they're actually a resident of a foreign country for tax purposes, maybe to avoid U.S. tax on their worldwide income.
Using a treaty to basically opt out of U.S. resident taxation, even with a green card.
Right. That strategic move, while potentially saving tax in the short term, can have a massive consequence. For a long-term resident, taking that treaty position to be treated as a non-resident can actually trigger the U.S. expatriation tax.
Wow. So trying to minimize tax using a treaty could inadvertently trigger a huge exit tax, as if they were giving up their green card.
Potentially, yes. The tax code sees that action formally claiming non-residency via treaty when you're a long-term green card holder as a potential expatriating event. It's a stark reminder that these tax decisions aren't just about the numbers. They're deeply linked to your legal status, your long-term presence, and even potential exit strategies from the U.S. system.
That's a really powerful point. Your tax filings and treaty claims send signals about your relationship with the U.S., something everyone in this situation needs to think about very carefully.
Indeed. Some serious food for thought there. Thank you for joining us on this deep dive.
My pleasure.
We'll see you next time.